remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability, again, is essential to set the stage for achieving maximum employment and stable prices over the longer run. Before concluding, let me briefly address the condition of the banking sector. The U.S. banking system is sound and resilient. As detailed in the box on financial stability in the Monetary Policy Report, the Fed, together with the Treasury and the FDIC, took decisive action in March to protect the U.S. economy and to strengthen public confidence in our banking system. The recent bank failures, including that of Silicon Valley Bank and the resulting bank stress, have highlighted the importance of ensuring that we have the appropriate rules and supervisory practices for banks of this size. We are committed to addressing these vulnerabilities to make for a stronger and more resilient banking system. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals.
That has taken place for a while now is the reverse repo market. So it's hovered over just over $2 trillion for the first half of this year, and it follows kind of exponential growth that we've seen over the past few years. So what's your assessment on the implications that the reverse repo market has on our economy?
Not much. It's just a place where holds money on the Fed's balance sheet. It's like a mutual fund. I mean, in fact, it's as the Treasury has been issuing bills to refill the Treasury General account, we've actually seen the reverse repo overnight facility declining. So,
isn't there some sort of conflict with higher reserve requirements, liquidity, and lending in the market? Or is there any tension there?
I don't believe so. It's just a place where largely money market funds have been putting their money. And as rates normalize in the economy, we're likely to see the reverse repo facility shrink dramatically. And I think without particularly important macroeconomic effects.
If you think about the implications, the Fed had to intervene in September of 2019 to provide stability and liquidity to that market. The fact that the Fed needed to use an emergency facility to intervene in the market would normally indicate some cause for alarm. Do you feel like that was an aberration? There's no more cause. Everything's been settled.
Well, that was about suddenly finding ourselves in reserve scarcity. So we'd been monitoring the level of reserves really carefully and thinking that we knew where scarcity would start to appear. And the problem is demand can be very volatile. So demand spiked and there weren't enough reserves. So you had a situation where we had to supply reserves in big quantities. That's not what's going on with the reverse repo facility was at zero for a very long time. And I think it's shrinking now. We don't know how much it will shrink.
Well, I think the growth of it kind of highlights some of the related concerns for inflation and tension between liquidity and frankly, when you look at the requirements for capital and the alternative returns in the market, there's concern. Well, all that capital can't be deployed in the same place. So when you have to pick places for it to be deployed, then it certainly has implications. So I would love to follow up with you on it. Maybe align my own views with the thinking at the Fed. And Mr. Gottheimer left off talking about non-banks and banks and kind of the regulatory framework. Recently, you published online the list of master accounts that the Fed has. Are any of those master account holders non-FDIC insured entities?
Are any of them? I don't know.
Could you get that answer back to us, please?
Sure.
Okay, thanks. So when I think about some of the dynamics that are going on in the market related to banks, non-banks, securities, not securities, one agency in particular has been very activist in this place over at the SEC, and it's kind of tangentially related to the Fed, but crypto and digital assets in the U.S. has got a market cap of around $1.1 trillion right now. It's been there for a bit. Do you acknowledge that this asset class has staying power in the U.S. economy?
It appears to have some staying power. Of course, that $1.1 trillion what was that a year ago? A lot higher.
Yeah. It's had some volatility in large measure due to the lack of legal clarity, and so hopefully this committee will will help that quite a lot here this summer with at least two bills, one on stable coins and one on market structure. And it'll be clear not just for Congress, but for regulators, including Chairman Gensler, and obviously market participants, whether they're forming the ideas or investing in the ideas or participating in the activities in the space.
I say you guys because I know you're the chairman, but there's other members as well. Do you have a view of the concern about community banking in the United States, or a lack thereof of community banking? It has been shrinking quite significantly over the past 10 to 12 years. Very,
very much so. It's a focus for us. We understand the importance of community banks, that they provide a different service and a really important service to smaller businesses and communities. And community banks have been consolidating for 30 years now. So it's really a secular trend as people have moved to bigger cities and things like that. But we don't want to do anything to move that along. We think that the world's not a better place with fewer community banks, and we try to keep that in mind in all of the regulatory and supervisory things that we.
I also want a broader view on this question of the vice chair for supervision is performing his own personal holistic review of the Fed's regulatory framework for bank capital and liquidity. In an interview yesterday, he discussed some version of a new type of stress test, even striking complete confusion in his description of it. And at the same time, we have testimony from you, even from the vice chair of supervision, saying that we have a sound banking system that is well capitalized. You will sit in judgment of this proposal that the vice chair for supervision will bring to the full board on this holistic review of capital. There are a lot of discussions about the amounts of capital he's talking about, the concern that this is pro-cyclical at a time where our economy with higher rates is you're measuring what's happening in the broader economy, and at the same time we're going to have a major piece of capital required by financial institutions, which will further restrict lending. So how can you tell us to think about that, given your seat on the Open Markets Committee and as a Fed governor? How would you interpret that?
So I guess I would say you're right. There are a significant number of proposals that are kind of in the works. They haven't been finalized, let alone brought to the board yet. And so I can't really get into specific details today.
Well, we like your thinking, Jerome Powell. That's what we like.
What I can share is principles and how I will think about this. Regulatory proposals go to the board. Every person on the board, that's 6 governors now, has an obligation to evaluate and vote on those. And I'm one of those people. I also chair the board. So a couple things I would point out. Just first that, I think regulation should be transparent and consistent and not too volatile, and particularly as it relates to capital requirements. I do note the central importance of capital. We want banks to be resilient to shocks. We want them to be able to lend in good and bad times. We want, in particular, the GSIBs, the 8 largest banks, to have very high levels of capital and liquidity. Indeed, we spent years raising those levels over a long period of time. And I think there's broad agreement, as you point out, that capital is strong. And, the question there will be what sorts of increases will be justified. That's what we'll be looking at. The other thing is to point out the trade-off between higher capital. The benefit of it, of course, is to have stronger banks that can lend and maybe survive more kinds of crisis environments. But, there are costs as well. And I think it's going to be, as always, a question of weighing and balancing those costs. And that's what I'll be thinking about. The last thing I'll say about that is just we benefit from having banks of all different shapes and sizes in our system. And we want to be careful not to regulate the smaller banks to the point where really their business models are challenged for all but the largest banks.
Chair Powell, Vice Chair Barr's report on the Fed's review of Silicon Valley Bank states that while there was regulatory tailoring conducted in response to S2155, there was also, and this is the part that really concerns me, a cultural shift at the Fed under the direction of the previous Vice Chair for Supervision, Randy Gross. According to the report, This shift included pressure to reduce burdens on firms, meet a higher burden of proof for a supervisory conclusion, and a need to accumulate more evidence than in the past. As chair during that period, were you aware of this cultural shift and the impact it was creating?
So I think we learned from the Silicon Valley failure and the others that there is going to be a need for stronger supervision and also regulation for banks of that size. And I'm committed to learning the right lessons from this exercise and to forthrightly implementing changes.
Were you aware of the cultural shift?
So I can't really characterize it that way. Certainly, I was aware that we were trying to avoid excessive regulatory burden. That
so
is
you
always
disagree with Chair Barr's report in that respect?
I'm sure that the people who wrote the report were accurately reporting what they heard from back in the day.
How often were you meeting with Vice Chair Quarles?
I reasonably frequently. We sat quite near each other.
And never discussed the cultural shift.
I didn't say that, but I don't remember it. The way you're describing it is not what I recall. I recall Vice Chair Quarles talking about things like focusing on the really important issues and not getting diverted into other.
So the way it was described by Vice Chair Barr is not what you recall.
Well,
so what
I had no part in. I said I had no part in preparing the report. I'm confident that the staff who worked on the report reported accurately what they heard. I'm sure that that's right.
So what steps did you take proactively to meet with regulatory and supervisory staff?
Well, I think we're taking significant steps now. We're as you know, under Vice Chair Barr's leadership, we're looking carefully at these events and asking ourselves, what do we need to do with supervision? And I think there is a point to be made that there are situations in which we need to be more forceful and more proactive. Not in all situations, but in some. In regulation, I think we're learning that we need to update our thinking around liquidity regulation, which was based on a certain speed of bank runs, which now looks to be outdated.
Was the Silicon Valley Bank failure a result of a liquidity issue?
I'm sorry.
Was Silicon Valley Bank failure a result of the liquidity issue?
Among other things, yes.
Signature Bank failure, the result of a liquidity issue?
Yes, I mean, that's not. There's also a lot of very bad management decisions being made here.
But liquidity. Yeah. First Republic, was that a failure result of a liquidity issue also?
Among other things, yeah. I mean, I wouldn't say just liquidity.
Well, all right. Were any of them a failure of having too low capital levels?
So let's go to Silicon Valley Bank. The issue that triggered the run initially was the presence of significant losses in their securities portfolio.
Yes.
And that is in it. That is a capital issue.
So they had too low a capital. The requirements. So what
they weren't required to, as you know, they weren't required to take that into account in their capital. But I think if you remember what people were focusing on was these portfolio losses, and then what people weren't focusing on was the fact that they had in excess of 90% uninsured deposits, and that's what caused the run.
So would increasing capital requirements for Silicon Valley Bank or any of these other banks or all banks together, would that have stopped these banks from failing?
That's a hypothetical, unknowable question. I think it might have helped. I think it might have helped, but
how much then? Increasing it by how much would have helped?
It's very hard to say. Very hard to say. I mean, clearly the main issue there was a failure of management to follow up, a failure of supervision to require them to follow up, and really the liquidity regulation was not appropriate. We needed to have stronger regulation around liquidity and uninsured deposits.
Last year, you said the banking system is very strong, well capitalized, highly liquid, does a much better job of understanding the risks that it runs and managing them. And just today, you said the banking sector seems to be strong. Do you still stand by those statements? I mean, just said it today.
Yes.
So, yep. Last month, Vice Chair Barr appeared before this committee, and he agreed with you. He said overall banks have a strong capital and liquidity. Secretary Yellen has said similar things. But today, even though you've all said that banks seem to have strong capital, you seem to lead us today by saying the bank's considering what increase would be appropriate of capital requirements. So has the board already decided that an increase will happen? They're just deciding what's the size of the increase for capital requirements?
No. What I meant to say, what I thought I said was that any increase above these levels would need to be shown to be justified.
So I understand, and you have a vote as whether or not what this proposal you'll vote on whether or not. Do you personally think that an increase is necessary at this time?
Do I think
that an increase in capital requirements is necessary at this time?
Look, I'm going to react to whatever the proposal turns out to be in the end, and give it my best assessment. And also, that's what I'll say.
Okay. You just also said that credit is tightening. Won't increasing capital requirements further tighten credit?
Over time, the thing about capital requirements is if we put a proposal out this summer, let's say, it'll be quite a while before that proposal is, agreed among the agencies and then voted on, and then it'll take some years to come into full effect. So I would think, whereas interest rates, for example, have immediate effects on financial conditions and then reasonably quick effects on economic activity, capital requirements are a much more sort of medium-term, longer-term thing.
So I'd like to move on to what the impacts on raising capital requirements would have. According to an academic literature by the Basel Committee on Banking Supervision, a 1% point increase in capital requirements could potentially reduce annual GDP by up to 16 basis points, showing that higher capital requirements come at a cost and could have significant impact on the U.S. economy. I discussed this with Vice Chair Barr last month, and expressed my concerns about what the impact of increased capital on the real economy, but he didn't answer the question directly. We're hearing from all sorts of industry that these increased capital requirements at any level would have a further tightening on lending. And if that happens, and I'm hearing from everybody, if that happens, it's going to be a real disaster. So I think anything that the committee proposes, if you could come back and brief us on before it's finalized, we would appreciate that very much, sir.
Has the Fed conducted so we can determine the impact of this warrantless regulatory action on small businesses and other marginal borrowers?
So with capital standards, it's always a trade-off. The more capital means a more stable, more sound, more resilient banking system, but it also at the margin can mean a little bit less credit availability, and also the price of credit can be affected. And there's no perfect way to assess that balance. Obviously, the answer is not zero capital. It's not 100% capital, so it's somewhere in the middle.
Thank you. There are estimated about 1.5 trillion of commercial real estate loans that are maturing in the next 3 years. And declining demand and the prevalence of work-from-home policies are putting a strain on commercial real estate market. The bulk of commercial real estate loans are held by smaller and regional banks. So is the Fed thinking about policies that could provide time for commercial real estate loans to be refinanced? And could an increase in capital requirements reduce liquidity in the commercial real estate loan market?
We're very focused on the commercial real estate situation. You're right, of course, that a good portion of the commercial real estate loans are held in smaller banks. And supervisors are very much engaged with those banks, and it's particularly banks that have a high concentration. That's what we look for among the smaller banks, and there are some of those. But there's a playbook for working your way, working your way out of these loans, and it's particularly in the office sector where work from home is still a pretty material factor in some areas, as you know.
The June Federal Open Market Committee report indicates inflation in the U.S. and abroad continue to ease but remain elevated. In response to the FOMC that has the proposed interest rate increases up until June 14th, recommendations to pause interest rate hikes for the first time this year, research has shown that the effects of monetary policy decisions, like raising interest rates, can take on average 42 months to be realized fully in the United States, meaning we may not fully understand the effects of this first increase in rates of March 2022 until next fall. With that in mind, how have our recent tightened monetary policies impacted the strength of the U.S. dollar and how it is valued globally?
Let me say that there's a lot of uncertainty around how long it takes monetary policy to affect real activity. There's no agreement on 42 months or any particular thing, and I think most people would say shorter than that. So you're asking how it would affect the dollar?
Yes.
So first of all, the Treasury Department has responsibility for the level of the dollar and the stewardship of the dollar as a currency. We don't actually comment on that. We don't look at any particular level. It's just to us, it's a financial condition. A stronger dollar means certain things, and a weaker dollar means certain other things.
Welcome to the Crypto Teacher. And you know I come back with that video just to make you think.
Don't forget to like and subscribe to the channel.
And guys, we had Bitcoin and crypto pumping while Jerome is in the house. And if you listen to Jerome Powell in front of Congress, we know it's time, guys. It's time for that main event because he's not telling us the truth. The U.S. banking system is sound and resilient. The reverse repo market is nothing. Oh, it's just there. Yes, $2 trillion just sitting there. Has no effect. But guys, we know that's not correct. It's all about liquidity. But Jerome Powell does state that digital assets are definitely here to stay. And why are they here to stay, guys? Because it's for the fourth industrial revolution. It's so the machines can pay each other. But before we get there, they have to destroy this legacy market, this current banking system, and that's the reason why they want to raise capital requirements. They know these small banks are not going to survive. That means that small businesses are not going to survive, and that equals mass unemployment. And we know the NWO causes the problem, wait for the reaction, and run in with the solution. And we know that's the reason why they're testing universal basic income. That free money airdrop to you that will be programmable, telling you what, where, and when and how to buy. And you have 3 to 6 months to spend it or poof, it's gone. And that's the reason why they're going to keep rates high for longer, along with the other central banks, to destroy this current legacy market so the digital transformation can rise. America to Babylon, along with the United States world reserve currency falls. The emerging markets led by China with that digital yuan backed by that digital SDR will rise like the phoenix. And remember, the Crypto Teacher told you, because he knows when it comes to the New World Order, it's all planned out. You have a wonderful day.
Going to a different economy, and we're going to be learning more about that as we go, but clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
And so we'll import Chinese-based CBDC technology. So it's going to be CBDC in a box provided to you by the People's Bank of China.
I actually believe this technology is going to be very important. Look at it. We have been part of a huge revolution in investing through ETFs. We believe that ETFs will be changing the whole way we invest. Many people still use it as a means, well, people are investing it for indexing. No, the majority of people who are putting money in an ETFs are active investors that are buying exposure. The entire bond market is being transformed as we talk right now. I believe the next generation for markets, the next generation for securities will be tokenization of securities. And if we could have that distributed ledger that we know every beneficial owner, every beneficial seller, we all have our code of who's buying, who's selling, instantaneous settlement. And think about it, it changes the whole ecosystem.
Cryptoteacher and the New World Order book, plus the 3 kids books. It's time to re-educate. Also, new to cryptos, Coinbase, Bitrue, Binance. Do not forget book links and crypto links are in the description. The stock channel, guys. Don't forget to go like, subscribe, spread everywhere. You have your Kobo, your chip stocks, your banking, your gaming. While everybody's sitting at home, get on stocks, the Seaver, the biotech stocks. And while everybody's at home wishing they were still getting that free money, what are they doing? Drinking and smoking weed. Don't forget about those stocks, and you have a wonderful day. The most powerful person in the world is the storyteller. The storyteller sets the vision, values, and agenda of an entire generation to come. Steve Jobs. And guys, you know I truly believe in this. When you look at the New World Order, they're the storytellers. And that's the reason why I wrote my New World Order book. But guys, now it's time to change the current generation. And I wrote 3 kids books. You know I love the Trinity because I understand the power that's in it. So I have 3 books. We have an opportunity to change the generation, to educate, not just me, but I want to show you that I take action on a daily basis. And I want you to take action on a daily basis. Whether it's your job, whether it's in your community, we have an opportunity right now to educate the masses. I posted this on my Twitter account. Please share, but this is a short clip of the 3 books. There's going to be a clothing line and action figures. Please get these books for your kids, nephews, cousins, friends, so therefore we can start the re-education now. Because as we see, the 4th Industrial Revolution foundation is definitely here. Robots, algorithms, drones, taking humanity out the picture. We have to re-educate. But let's get into the video.
Part 1. King Joshua and Grandma Tam save the village. Part 2. King Joshua and Grandma Tam save New York from COVID-33. Part 3. King Joshua and Grandma Tam goes to China.
It's mandatory to get part 1, part 2, and part 3 of this series. It's time to re-educate Generation Z.